Hey guys, how are you? My name's Adam Jason. I am the founder of BRRRR.com. And with this video, as with all my other ones, I want to bring to you, I think, a unique perspective and ways in which you can improve your investing and your BRRRR investing and make your portfolio more secure based on my years as a real estate investor as well as an attorney for clients doing transactions in real estate all over the globe. So I'm making this video in the time of COVID-19. I think it'll still be applicable whenever you're seeing this because it answers a very fundamental question that we ask as BRRRR investors. So as you know, BRRRR process includes buying a property at value, rehabbing the property so that you increase that value, getting a tenant in the property to stabilize it, and then the part where people often have the most questions and where there can be the most uncertainty, and what I want to talk about today is the refinance portion of your transactions. So really what the question is and what we want to hone in on is, how much can I borrow? You know, in this time of COVID-19, you have a lot of factors that are competing in this in the discussion here and how to answer that question. So you have a time when interest rates are lower than they've ever been before, but at a time when people have more uncertainty than they've ever had before when it comes to the general economy, when it comes to their jobs, what their income situation is going to look like. So I think it's better to apply some general rules, think about it that way, and then everybody can analyze their own situation and think about whether they can take full advantage of these super low loan rates that are out there and whether they're going to be in a position to do so, or if it's better to wait a little bit or plan for a longer refinance period, whatever your personal position is. So as you know, fixed rates right now on a 30-year mortgage are at 2.98, 3%, incredibly low, which makes borrowing obviously super attractive. Here's the thing with that. To get that kind of rate, you're going to have to go through traditional lending institutions. So the banks that you know, the community banks that you work with, it's not going to be the kind of rate that you're going to get if you're working with a private lender or in a hard money situation. So what does that mean? Really, the fundamental question that the banks and the lenders are going to ask when they're considering you for a loan and they're going through the underwriting process is, what is this person's debt to income ratio? So it's really a question of, okay, this person earns $10,000 a month. How much after we issue them the mortgage is their debt commitment going to be? So that can be not only the debt that you have on properties, but it's also going to take a look, obviously, at your credit card situation, if you have student loans, those kind of things. So as you're preparing for making offers on properties and getting comfortable around whether you're going to be able to refinance, the general rule really is that your debt to income ratio is going to have to be about 33%. So what do I mean by that? After you get the loan, so it's always on a post-issuance basis, the total debt that you have on a monthly basis is really not going to be able to exceed 33% of your total income for that month if you want to get a loan from these traditional institutions that are giving you the best rate. So it's an easy math test that you can run and think about. If you don't see it as an issue, even if you have in these times kind of an unforeseen economic event where you might lose a job or take a furlough or have a reduction in income, then it's not a big deal. If you're concerned about those kind of things, then you might want to rethink kind of your plan and what you want to do on the refinance perspective, because I'd hate to see you buy a property thinking it's going to be a smooth process. You're going to refinance in 6 months, but then you're going to have these conversations with these banks and they're going to say that your debt to income ratio is too high. So something to definitely think about. Make sure you're doing your numbers, getting comfortable around what for most of us is honestly the most kind of confusing and challenging part of the BRRRR process, but also the most rewarding when you're taking all the money that you put into a project, getting that back out, seeing that in your bank account so that you can go and do more projects. If you found this video helpful, come over to BRRRRinvest.com. We have tons of resources there for investors, including our membership option to sign up and use all the legal contracts, analysis tools, everything that I use for my own portfolio, as well as tons of free resources for making sure, for example, as you work with your lenders, you're asking them the right questions, you're not leaving anything out. We have a great free tool there where you can compare lenders side by side, really get all the answers you need so that you're making intelligent decisions. And then we're just packed full of articles and anything that you can need as a BRRRR investor to really take your portfolio to the next level. So BRRRRinvest.com. Again, I'm Adam Jason. Thank you so much for watching the video, and I'll see you in the next one. Thanks.